Now, in this segment, we're going to look abroad, and we always want to start with Russia in terms of where some of the flows are. So here you can see that the flows are still going into the Netherlands, but have dropped off everywhere else. But when you look at where OSPs are, how that could impact things going forward, right now, technically, if they were to set the price cap at $60, $65, euros are in the money. Like you could buy euros in that current price cap. It still needs to get approved. It would roll out in December, but that is going to be something interesting to watch when we look at some of the different optionalities that Russia has, because at this point, the price cap is going to legitimize a lot of this crude. And we've highlighted multiple ways that countries could get around them. And there's a lot of opportunity for that to happen here as well. So it's going to be an interesting one to watch, but you can see that the drop off, and this drop off is also putting more crude on the water, which is increasing miles per ton, increasing rates. When you look at CPC, there's CPC shipped 1.14 million barrels a day from January 1st to November 15th. The bigger issue at this point now is spare parts, because we've seen CPC running at 9-month highs. There's a hope that remember there's 3 piers, that the last pier was going to come on, but if they're halting on spare parts, there could be a concern about that full comeback of that crude. We've already seen differentials go from $8 below Dated Brent to 10. So there's clearly already enough. So this isn't a huge deal. But if you start to see another cut from OPEC, that could, again, create a bit more stress as we go through, as we head into the OPEC plus meeting. So I think it's important to talk a bit more about OPEC and OPEC plus. So when we look at what could happen, we do see that there's going to likely be, we think, a cut of about 250,000 barrels a day. There's some view that they won't do anything because they did move the meeting online. And because it's now online, you're not going to hash things out. So there's a bit of a view that there could be no change. I think if there is a cut, which in my opinion is likely, it's going to be driven mostly by Saudi Arabia. And the reason why is because, and we'll talk about the Middle East floating storage, there's a lot of floating storage out there. So realistically, they should be cutting anyway for economic reasons, but why not use this as an opportunity? So with that being said, cut the OPEC production, have the lion's share of it to being taken by Saudi Arabia, but also decrease OSPs, because you still need to clear that product, and you're going to try to compete with Russia as much as you can. And I think that's going to be some of the key pieces. So here's some of the expectations just from people out in the market. Saudi Aramco may reduce the January OSP of Arab light crude to Asia buyers by $2.10 a barrel month on month. I think if realistically they should be more aggressive. They may not be, but in my opinion, based on the amount of product in the market, they should cut it further, which would then incentivize additional runs, especially when you look at Russia Asian customers, because the Asian customers are taking up where the product used to go to Europe. Now more and more of it is heading into Asia, and they have to find a way to compete with that flow. Chevron was given the opportunity the permission to operate in Venezuela again, but they're producing 660,000 barrels a day. So, all right, they get back in there. Well, how is everything? How is the pipelines? How are the production levels? How is the equipment? What needs to be repaired, replaced? Maybe they get to 700,000 barrels, but we're not going back to 1.2. So you still have this, even though we're getting back into some of these areas, there's still going to be that shortfall on the heavy side. And again, this is another reason with Russian product going into the market, and some of it's going into quote unquote unknown Asia, which means it could just be cleaned up and rehashed as Malaysia with the ship-to-ship transfer, or they're trying to get in front of it because they know that's where it's going to be consumed anyway. And these are going to be a lot of things that the Middle East is going to have to address given the level of the floating storage. When you look at it, this is the most floating storage in the Middle East for all of 2022. And this is the most in there since the beginning of 2017. So you're looking at a significant amount of product. And again, taking away 2016, you can see that 2021 through 2017, there's a drop off in floating storage and into the end of the year because you get a big buying spree as countries and companies look to, again, refill their storage from the drawdowns that happen during peak winter season, because a lot of this crude really isn't going to be turned into product if it's purchased today until really March of next year. So again, you're starting to already look at, all right, well, how do we refill storage? How do we start to manage this? So we should be seeing more buying, not less. But that's why we expect to see a big discount coming from the Middle East. U.S. flows still remain elevated. This is showing a 4-week rolling average at 4.14. Again, we still think it's a little bit lower, but still at a very high level, a very aggressive level. The surge also comes as Pad 3 tries to make sure that there's less product in storage, keeping some of those flows moving through. But again, that's where we continue to see a lot of support for our exports in the near term. When you look at Dubai versus Brent, you can see that there's still that discount of about $6.65. When you look at some of the different flows, this is looking at it slightly differently just because the chart I normally use wasn't working, but it gives you the same idea in terms of spreads. So you can still see that Dubai is much cheaper. It's going to stay cheaper just given the amount of product and storage. So even though Brent prices have moved up and down, you can see that it's still maintaining its discount because they're trying to clear product, and it makes sense to, again, keep that moving a bit cheaper. Crude oil on the water has started to come down, and this is more because of the delay of new movements from Russia. And a lot of that crude has gone from transit to floating storage, and some of the product has gone from floating storage into crude on storage on land. So here you can see that we've had a drop in transit. We're still at a very high level, seasonally adjusted speaking, highest of all time for right this period in time. We see it stabilizing right around here. Flows into Asia are still there, but they are starting to diminish. We do see some additional movements into the U.S. and Europe, which will help bridge some of this gap in the near term, but we don't see it going back to the highs of 2022. Just more along the lines of staying fairly flat at these current levels. And here's just giving an idea of as that floating storage, as that transit comes down, floating storage going back up. And as we were highlighting, the comps got much easier. And that's why we still think that we're going to kind of close out the year right at these levels. There'll be some waffling back and forth, but there's still more than enough crude in transit. There's still a lot of issues, especially in China, in terms of that product moving from offshore to onshore. And that's going to keep floating storage very elevated unless, and again, we have to see OSPs. If we get a big drop in OSPs, that could start to accelerate things in January, but that still is going to leave us with a lot of crude in December, which is why we should see some additional cuts in differentials as we go through the first and second week of December. More likely the second week of December, we'll start to see those cuts get more aggressive to try to move product. Asian floating storage, here you can see that we're starting to see that bounce. We expect it to continue to rise at a fairly steady pace, just as those cargoes show up that have been flagging the region. Now, road traffic in Asia, in China, has diminished. You can see for 2022, it's essentially since September, they have been unable to get back to that normalcy. Now you can see that there's even more lockdowns. There's a lot of uncertainty. There's been a lot of protests creeping up in that region, which again is going to diminish the amount of people are willing to move, or to be honest with you, have the ability to move. And that's going to be a very continuous issue at this point in time, which we don't see adjusting. And the reason why that's a problem is because, well, the amount of China super tankers indicating China is back to the highs of 2021, and seasonally adjusted speaking, the highest they've been going back to 2016. So there's a lot of crude coming in, but not a whole lot of movement on the product side and the flow side, which again keeps us a bit muted. So when you look at runs have remained fairly stable. We actually see this moving to the downside and coming closer to 63 with some more pressure coming, especially as those cargoes show up and those protests and everything else lockdowns get worse. And some of the key things that I think is important to talk about, China can't let people think protests work. And that's why control is paramount. So again, as much as people like to think that China is going to get aggressive and is going to reopen, we see some headwinds to that philosophy. West Africa crude, back to the highs, moving back up. Floating storage, as we've been discussing, Nigeria is struggling to sell, Angola is struggling to sell. China hasn't been a big buyer. And Europe has slowed down significantly. And again, with Dubai trying to get cheaper and cheaper to compete and to get incentivize flows, that's going to have to drive down additional differentials in this market. U.S. crude exports, gasoline went back to the highs. Distillate, same thing. Again, PADD 3 trying to manage their flows. Propane, propylene, given the amount in storage and the amount in production, we're very much cost competitive into the international market. Exports are going to remain very robust. Total crude exports came in at 4.9. Mathematically speaking, that's impossible just based on infrastructure. So there was some of that catch up. We should see a fairly decent drop off, but we don't see too much happening in the near term when we look at flows. And by that I mean we still see that 3.8, 3.9 million barrels a day on average, because there still is that demand for U.S. product, especially U.S. crude. Gasoline exports back to the highs, as we expect it to remain above the 5-year average, trying to manage some of those flows. A lot of that going into both, mostly into Latin America at this point in time. On the distillate front, a bit of a recovery as things get a bit colder in Europe. You're going to see some of those distillate storage come down, and that's going to pull some additional product into the market. So that's going to keep distillate exports leaving from the U.S. into the European markets fairly stable. And at these levels, I mean, it'll bounce back around a bit just based on timing delays, but we expect to be above that 5-year average. Oil exports remaining strong. Again, we don't see that changing. Then when you look at propane, propylene staying strong, again, we don't see that changing, especially given the price shifts. When we look at Fujairah's recorded a drop of 2.627 million to a total of 22.51 million barrels. Draws were across all three, with heavy resid showing the largest. Light distillate fell 1.173 million to 6.33. The East of Suez gasoline complex softened in the market as U.S. RBOB and Brent crack spread as they weakened as we get to the other side of Thanksgiving. And then in China, gasoline exports in November are expected to total 2 million tons, up from 1 million tons in October, which is going to replenish a lot of that, which is why, as we've been saying, we expect more of that to show up in Singapore, and that'll push more into Fujairah. Middle distillate fell 241,000 barrels to 2.973. East of Suez gas oil complex seen some pressure from a combination of higher outflows from China and weaker east to west arbitrage economics, which have been factors leading to softening backwardation. The arbitrage of gas oil to the west is facing further headwinds from, again, freight rates going up, which have made the long haul journeys more expensive, which is why that again is going to support more exports from the U.S. because it's not, the arb is closed, which is going to leave more middle distillate in Fujairah and Singapore and pull more from the U.S., which is again going to shift some of those moves. But if we need to pull more from this region, which I think is likely, we're going to have to see European and U.S. prices go higher in order to incentivize these moves and price them in. Heavy resid fell 1.213 million to 13.2 million barrels in storage. as flat prices were there. And then realistically, it's just a bounce back and forth. We got a little bit of a reprieve with some shipments, but realistically, we don't see too much on the good side of the heavy disty front. Brent time spreads, you can see, have come way down. A lot of this is being driven by freight rates and storage. You have to incentivize storage somehow, and the way to do that is by bringing those freight rates. As freight rates go up, you have to incentivize contango. This is kind of showing you some of that pivot from backwardation into contango to cover some of those different costs in order to keep them on the water. When you look at flows in general, you can see that things haven't changed all that much. We haven't seen too much of a shift. We should get some more updates as we go through this week and into next, and we'll see how some of the flows have moved. Genscape, when you look at Europe, European storage bounced as we said it would based on that floating storage dynamic. And we just think that European storage levels for crude are going to just live within these levels. Insights for gasoline, naphtha, and gas oil in Europe. So here, when we look at gas oil, drifting back up, still at the very low end. Some of this is being pulled in from both the Middle East, as we've seen some Middle Eastern cargo show up. That arbitrage is now closed. So now it's really going to rely more on the U.S. But as we get a bit of a cold snap coming through, we should see this hang out at the lower end of the levels. Gasoline staying fairly flat, below where we were in 2020, but you can just see how far above we are versus normal. And just given some of the dynamics and how the arbitrage from Europe into the U.S. remains tight, this storage is going to remain very elevated. Fuel oil starting to move back up. Again, this is because that arb going from west to east is also closed. So we see they're going to try to recrack what they can, but a lot of this is going to live in storage. When you look at Singapore, small drop of about 1 million barrels in storage. Light distillate, small drop of 200,000. Middle distillate had an increase, with the biggest drop coming from the residual side. When we break it into its components, light distillate is kind of back in the top end of the range. As we were saying, now that the festivities have passed, a lot of that product has come back through. China is sending more into the market. We do expect this to increase and follow and just remain at the very top of that range, just based on the economics of it. On the middle distillate side, things still remain fairly tight. We don't see that changing. We'll see some increases because crack spreads are still supportive of runs, so runs are still going to happen. But we're just not going to see the same type of movement going from east to west, which will leave more in storage. So we should see some creep higher, but still remain at a fairly bullish backdrop. And then the resid side is just hanging right at that 17 or so year average, and we don't see that deviating too much as well. North Sea floating storage still remaining elevated. Differentials, again, are going to have to come down to move some of this product, as we've been discussing. And then European floating storage still remaining high at the especially at the higher end of the current historics. And that's going to support more crude in storage and keep us, again, at that elevated level when you look at that total of storage levels onshore in Europe. So that's what we have for you today. I apologize again for that nasally voice. Hopefully I start to feel a bit better and we can get back to a bit more normalcy. And we again, as we said before, we hope you had a great Thanksgiving weekend, a great Thanksgiving week, time with family and friends. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.